Remember this: at dusk on the evening of the 22nd of November 1910, a group of reporters stationed at the railway terminal in Hoboken, New Jersey, watched a private rail car pull silently away from an unfrequented platform. They had seen several of the most powerful men in American finance board it, one at a time, carrying luggage for an extended absence. No one would confirm their names. No one would confirm their destination. The men aboard that car were traveling under assumed first names only. They had been instructed to arrive separately so as not to draw attention. One of them had borrowed a hunting rifle he had never fired because the cover story required it. They were, officially, going duck hunting. Senator Nelson Aldrich of Rhode Island sat at the head of the group. He was, at that moment, one of the most powerful legislators in the United States, chairman of the Senate Finance Committee, architect of Republican fiscal policy, father-in-law to John D. Rockefeller, Jr. Beside him sat Henry Davison of J.P., Morgan, Frank Vanderlip of National City Bank, Paul Warburg of Kuhn Loeb and Company, A. Piatt Andrew of the United States Treasury, and Aldrich's private secretary, Arthur Shelton. 6 men, representing, between them, an estimated 1/4 of the entire wealth of the world. Their destination was the Jekyll Island Club on the coast of Georgia, the most exclusive private club in America, described in Munsey's magazine as the richest, the most exclusive, the most inaccessible club in the world. Accessible only by boat, its membership drawn from the Morgans, the Rockefellers, and the Vanderbilts. J.P. Morgan himself had most likely arranged their access to the club's facilities. They would spend 9 days there. When they left, they carried the draft of a plan that would eventually become the Federal Reserve System, the most powerful central bank in the history of the modern world. The meeting would not be admitted publicly until the 1930s. To understand what made the Jekyll Island meeting remarkable and why it was kept secret for 2 decades, you have to understand what each man represented and why their combined presence at a single table was the most significant concentration of financial and political power in American history to that point. Nelson Aldrich represented political authority. As Senate Finance Committee chairman, he controlled the legislative pathway to any banking reform. President Theodore Roosevelt had called him the kingpin of the Republicans. Hostile journalists simply called him the boss of the United States. His daughter had married John D. Rockefeller, Jr., connecting the most powerful legislator in American banking to the most powerful oil fortune in the world. Henry Davison was J.P. Morgan's senior partner, the operational representative of a private banking house that had effectively acted as the United States lender of last resort just 3 years earlier. Morgan himself did not attend. He did not need to. Davison was there in his place. Frank Vanderlip was president of National City Bank, which would become Citibank, at that time the largest bank in the United States. Vanderlip represented the commercial banking establishment's interest in a system that would stabilize and protect the country's most powerful financial institutions. Paul Warburg was the intellectual core of the gathering. German-born and European-trained, intimately familiar with the Riksbank and the Bank of France, he had been arguing publicly for years that the United States needed a central bank on European lines. He spoke with technical fluency that the American participants could not match. The problem Aldrich knew he faced was political. If any journalist discovered that the bill to reform the American banking system had been written by the very bankers who stood to benefit from it, the project was finished. The secrecy was not incidental, it was the prerequisite. Before we go further, if this kind of history matters to you, consider subscribing to the channel. Every video here is built around the financial decisions that actually changed the world. The crises, the policy failures, the moments when the system revealed what it was designed to protect. If that is the kind of analysis you want to keep watching, the subscribe button is how you tell us. And we want to hear from you. Did you live through one of these turning points? The 2008 collapse, the 70s oil shock, the end of Bretton Woods? Did it change your family's circumstances, your understanding of how money actually works? Leave it in the comments. The most complete record of these events is not in any official report. It is in the people who were paying attention. Now, back to the account. To understand why the 6 men were willing to go to such extraordinary lengths to conceal their meeting, you have to understand what had happened 3 years earlier. Because Jekyll Island was not the origin of the problem. It was the response to it. On the 22nd of October 1907, the Knickerbocker Trust Company, one of the largest and most respected financial institutions in New York, slammed its doors on depositors and suspended operations. The news spread instantly. By the following morning, queues stretched around the block outside every major trust company in Manhattan. The New York Stock Exchange had already fallen nearly 50% from its peak the previous year. Industrial production would drop by 16%. Real gross national product would contract by 11%, a decline twice as severe as the 2007-2008 financial crisis. The United States government had no mechanism to respond. The Treasury pumped millions into the system. It was not enough. Banks continued to fail. Trust companies continued to suspend operations. And the man who ultimately steadied the system was not a government official. He was J.P. Morgan, 70 years old, operating from his private library on Madison Avenue. Morgan summoned the leading bankers and financiers of New York, ordered them to open their books, and, according to documented accounts, locked the doors and refused to release anyone until they had collectively pledged the funds necessary to prevent a full collapse of the system. By 4:45 in the morning, the bankers had signed. The crisis was contained, but the lesson it taught was devastating for the credibility of the American system. The stability of the United States financial infrastructure had rested not on public authority, not on institutional design, not on any mechanism of government, but on the personal decision of one aging private banker. Jacob Schiff of Kuhn Loeb and Company had warned in a speech earlier that same year, "Unless we have a central bank with adequate control of credit resources, this country is going to undergo the most severe and far-reaching money panic in its history." His prediction had just been proved correct. In the autumn of 1908, Senator Aldrich sponsored legislation creating the National Monetary Commission, an 18-member body charged with studying the financial systems of Europe and recommending reforms to Congress. Aldrich chaired it himself. He hired Henry Davison and the economist A. Piatt Andrew as advisors. For 2 years, the commission studied central banking in England, Germany, and France, visiting European institutions and interviewing their governors. By the autumn of 1910, Aldrich had learned what he needed to know. A central bank was necessary, but he had no concrete plan and no bill to present to Congress, which was about to reconvene. Henry Davison suggested the solution: take a small group of the most knowledgeable men available to a private location and draft the plan in concentrated secrecy. What emerged from 9 days of working sessions at Jekyll Island was called the Reserve Association of America. It was a single central bank with 15 regional branches. Each branch would be governed by directors elected by the member banks of that region. The branches would hold member bank reserves, issue currency, discount commercial paper, and clear checks. The national body would set discount rates for the entire system. Paul Warburg was, by virtually universal scholarly agreement, the intellectual architect of the technical design. His knowledge of European central banking, the Riksbank's elastic currency, the Bank of France's discount mechanism, provided the model. Frank Vanderlip later wrote that Warburg's analytical contribution was so fundamental that the Federal Reserve System, as it eventually emerged, was, in its core mechanism, largely his creation. The plan structure was deliberately designed to deflect one of the strongest political objections to a central bank: that it would concentrate power in the hands of New York bankers. By distributing governance across 15 regional branches, each answerable to local member banks, the Jekyll Island plan could present itself as a decentralized, democratic institution rather than the instrument of Wall Street. Whether that design achieved its stated purpose is a question that historians have debated for over a century. The plan that emerged from Jekyll Island faced an immediate political obstacle. In the November 1910 elections, the very month the meeting took place, the Democrats had captured the House of Representatives. By 1912, Woodrow Wilson would win the White House. The Aldrich Plan, named after a Republican senator whose ties to Wall Street and the Rockefeller family were among the most discussed in American public life, was politically toxic to any Democrat. The reformers had to regroup. The solution was elegant. The substance of the plan would remain largely intact, but it would be recast as a Democratic bill. Virginia's Representative Carter Glass would sponsor it. The name Aldrich would disappear from the legislation entirely. The Federal Reserve Act, as it became known, would be presented not as the creation of Wall Street's most powerful bankers, but as a democratic reform, a measure to liberate ordinary Americans from the financial oligarchy that had long controlled the nation's credit. The political theater required was considerable. Senator Aldrich's name needed to be kept off the bill, despite the bill's fundamental similarity to what he had drafted. Paul Warburg, widely credited even at the time as the plan's intellectual architect, gave testimony before Congress on banking reform without admitting his role in the Jekyll Island meeting. Frank Vanderlip later wrote that he had never heard Aldrich say a word about Jekyll Island in public. On the 23rd of December 1913, President Woodrow Wilson signed the Federal Reserve Act into law. It was 2 days before Christmas. Congress had been in session for months. Many legislators had already left Washington for the holiday. The act passed with considerably less scrutiny than it might otherwise have received. Paul Warburg, who had emigrated from Germany to champion the cause of American central banking, was appointed to the first Federal Reserve Board. The Federal Reserve System that came into existence in 1914 was not a government agency in the conventional sense. It was, in its structure, a hybrid, a public mandate administered through private institutions. The 12 regional Federal Reserve banks were privately owned by the member banks of each district. The Board of Governors in Washington was a public body. The mechanism by which private banks elected some of their own overseers built into the system's foundations the very tension the Jekyll Island participants had sought to navigate. The system that Warburg had designed around the principle of an elastic currency performed its intended function almost immediately. In 1914, the outbreak of the First World War created extraordinary pressures on financial markets. The Federal Reserve was able to expand the money supply to meet the crisis in ways that would have been impossible under the rigid structures of the pre-1913 system. The panic that many expected never materialized, and the secrecy. The participants kept faith with it for nearly 2 decades. In 1916, B.C. Forbes, the founder of Forbes magazine, published an account of the Jekyll Island meeting. It was largely dismissed or ignored. The participants denied it. Forbes was not able to produce enough corroborating evidence to shake the silence. The silence finally broke in the 1930s. Frank Vanderlip, writing in the Saturday Evening Post in 1935, disclosed the meeting in detail. By then, the Federal Reserve had existed for over 20 years, had navigated the First World War, had failed to prevent the crash of 1929 and the banking collapses of the early 1930s, and had undergone substantial restructuring under the Banking Act of 1935, which shifted authority firmly toward Washington. The institution had long outlasted the controversy of its origins. Warburg himself, in his 2-volume History of the Federal Reserve published in 1930, stopped short of naming Jekyll Island directly. He described being invited to a private conference in November 1910 to help draft the banking reform bill. He confirmed that the rough draft of what became the Aldrich Plan had been agreed upon at that conference. He did not name the location. He did not need to. By 1930, anyone who had been paying attention already knew. Paul Warburg, writing privately before his death in 1932, summarized what he had done on Jekyll Island with a characteristic economy. The matter of a uniform discount rate, he noted, had been discussed and settled there. He did not elaborate. He did not need to. That single technical mechanism, the ability to set interest rates centrally, was the instrument through which every episode of monetary policy in the subsequent century would be executed. The Federal Reserve that emerged from those 9 days on a Georgia island has, since its inception, shaped the contours of every significant financial event in the past 110 years. It determined the monetary conditions of 2 world wars. It failed to prevent the Great Depression and drew the lessons that informed its response to 2008. It managed the inflation of the 1970s imperfectly and the Volcker shock that ended it. It bought trillions in assets during the 2008 financial crisis and the COVID-19 pandemic. Every interest rate that millions of households have paid on mortgages, car loans, and business borrowing since 1914 was set, directly or indirectly, by an institution whose foundational design was drafted by 6 men who arrived on a boat at a private island, referred to each other only by first name, and denied for 20 years that the meeting had ever taken place. The question the Jekyll Island story invites is not whether the Federal Reserve was a good idea. The evidence on that question is mixed and contested. The question it invites is simpler and more fundamental. When the rules of money are made, when the institutions that govern credit, currency, and financial stability are designed, who is in the room? In November 1910, the answer was Nelson, Harry, Frank, Paul, Piatt, and Arthur. No one else was consulted. No one else was informed. The reporters at Hoboken Station watched the train leave. They had no idea what was on it. If this account has given you a clearer understanding of how financial power actually operates, subscribe to the channel. There are more crises, more decisions, more turning points still to document. And if this period of history connects to something you lived through or something a family member witnessed, the bank runs, the inflation, the austerity, the moment a system everyone trusted stopped working, tell us in the comments. What did they see? What did it cost them? What did they believe afterwards? The official version of these events is always written by the institutions that survived them. The fuller version belongs to the people who did not.